Hey, hello investors and future investors. Welcome to the channel. For today's video, I implore you, do not buy the dip. If you're new to options trading or you're thinking about getting into options in order to make that little extra money in order for you to supplement your regular income, then continue watching this video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to show you how to actually buy the dip. The dip that we have going on right now, do not buy it. I'm quite sure you have seen several videos saying buy the dip. I'm actually going to show you how to buy the dip. So, before we get into this video, I want you guys to do yourself two favors. Favor number one, I want you to go ahead and always do your own due diligence before investing. And favor number two, always make sure to have an exit strategy before entering any options trade. That being said, let's go ahead and get down and dirty with options. Now, when we say we're going to get down and dirty with options, it means that what we're going to be doing is giving you a complete walkthrough of our mindset and what we're going to be doing in order for you to be able to follow along with us. There is only one sure way to learn options, and that is by practice, practice, practice. For today's video, we're going to be using none other than Palantir Technologies, ticker PLTR. Now, full disclosure, I do not have Palantir in my portfolio based on my own personal preference. I think Palantir is an extremely good company. However, I think the stock price is highly overpriced, so that's why I chose not to get into this stock. But it's going to be good for a perfect example for today's video. Now, the dip. What is the dip? So let's get started by going into Robinhood Advanced feature. And to do that, you just click the Advanced feature right to the top here. When that opens up, that's going to give us this graph right here. Now, I have made a video about this just recently, so go ahead and check that out. Let's go into the 3-month chart. Now, the thing I want to bring to your attention is the RSI and also the moving average. So if you look to the side here, you're going to see MA200, which is the 200-day moving average. What this helps us do is that this helps us determine the price the stock has been trading at over the last 6 months or 200 days. Now that's going to be depicted in this video with the blue line. So if we follow the blue line right here, you're going to see that the average price of this thing has been around, let's go ahead, it's been around $47.89, or let's round it up to $48. So over the last 6 months, Palantir's average cost has been $48. Keep that in mind. Now, the other thing I want to bring to your attention is going to be the RSI. So that's going to be right here, RSI 50, and that's going to be depicted with the little orange line, and that's always to the bottom of the graph right here. So what we're going to do, we're going to follow this RSI line all the way out to the top first to get a figure. Now, as you can see here, the RSI is around 56 over the last 3-month period. Remember, you could use these right here, or you could also go to the year. It should be around the same. So Robinhood is new to charting, and Robinhood is very justified in a charting system. However, I don't think it gives you a very detailed visual picture of the graph. So we're going to jump into stock charts in order to go over that. So right here, you can see I'm on Palantir Technology. You can see that to the top here. Now we're going to be doing the exact same thing, and we're going to be tracing those two lines. For this graph, the 200-day moving average is highlighted by the red line right here. So if we follow the red line right here, you can see, just as Robinhood, it said that the average price over the last 6 months or 200 days was around $48.22. And as you can see, the stock is trading at a whopping $90, which is almost double of the average cost. Now, okay, so let's go ahead now and we're going to get into the RSI. The RSI is one of my favorite indicators I use to decide when to get into a stock and what strategy to actually use to trade that stock. So the RSI is this down here. And what the RSI measures, it actually goes from 0 all the way to the bottom to 100. But we don't actually focus on that. What we focus on is the 30 mark to the 70 mark. For those of you that's new to the RSI, I'm just going to give you a very brief introduction to what it is. So any stock that's trading above the 70 mark here, it simply indicates that the stock has been overbought. Any stock trading below the 30 mark here, It simply indicates that that stock has been oversold. So the RSI pretty much is a momentum indicator. Now, what I want to bring to your attention is the dip. So these little downward spirals here is known as the dip. There's one right here, then there's another one right here, and there's another one right here. And that's also depicted by the bottom here, by these little gaps right here. Now, when people say buy the dip, they do not actually mean to buy when the stock is going down. That is not correct. Let me show you how to buy the dip. When you decide to buy the dip, you need to stay in the dugout. You need to be patient and you need to wait until it's your time to bat. Stay on the sidelines and wait. What are you waiting for? You're waiting for this line right here, that upward momentum chart. Every time there's a dip, it's going to be followed by an upward momentum chart. You need to wait until the stock shows clear signs there's upward momentum before jumping into the stock. And that is what they mean by buy the dip. Now, let's go ahead and show that one more time. As you can see right here, the stock is in the bottom. And then this line goes up here. You buy any point on this line. And just one more time, right here again, you could see it featured. Now, why do you want to wait until the stock is going up and it shows clear sign that is going up? Because despite what anyone has told you, no one knows the bottom of the market and no one knows the top of the market. I mean, some people could guess, and every now and again they will be right, but no one knows for sure. The only way for you to protect your portfolio and always be a winner is to make sure you wait until the dip stops dipping, and then you see clear upward signs of momentum, and then you get into the stock. Now, when choosing options, how does this work for you? Well, let's go ahead back to Robinhood, and we're going to go ahead and feature it. Now, before I go back to Robinhood, when the stock is going down, that is the dip. I'm going to illustrate what strategy I would use personally. You don't have to do it. That's just what I do with my portfolio. Now, when the stock is going up, I'm going to show you what strategy I would use. Once again, this is just based off of my own personal preferences and my portfolio. Feel free to do what you want to do with your portfolio. It is your portfolio. No one can tell you otherwise. So let's go ahead. We're going to go back to Palantir. And then now we're going to go ahead and get into the Palantir options by going to trade Palantir options. Now with these strategies, I'm not going to go into detail because I have several videos on these strategies. Now, the market is in a dip or a decline. So what I would do is that I would sell covered calls. And yes, covered calls is a bearish option strategy. The reason why it's a bearish option strategy, let me show you. Let's go to sell. Let's go to call and let's choose May 7th. This is just an example. Please do not copy these trades. So for the covered call, let's say I take the $92 strike price. The reason why the covered call is a bearish option strategy is because I'm of the mindset that this strike price here is not going to go up to get to the $92 strike price. Hence, it's a bearish option strategy. Now, whenever the dips stop dipping and the stock starts to go up, then I would switch over my strategy and I'll be doing what's called a cash secured put. Now, the cash secured put is a bullish option strategy, and let me show you why. With the cash secured put, let's say I decide to choose the strike price of, let's say, $86. I am of the mindset that I do not want this share price to go down to 86. Now, if I don't want it to go down, that means I'm thinking it's going to continue going up or it's going to stay above the 86. Hence, this is a bullish option strategy. Now, let's go back to the sell call or what's known as the covered call option strategy. Whenever the stock gives you clear signs that it's going to go up, that is when you buy the dip. Now, when you buy the dip, there's three option strategies that I would use in my portfolio. Number one would be DCA, which stands for dollar cost average. With the DCA method, all it tells you to do is just keep buying the stock, whether it's going up, whether it's going down, over a certain period of time. What that does is that it gives you an average cost, which is going to be better than if you are jumping to the stock all at once on the same time and on the same day. Now, the other strategy I'll be using when the stock shows clear signs is going to be going up is going to be I'll be selling puts. Like I just mentioned before, the reason I'll be selling puts is that the stock has showed clear signs is going to be going up. So I'm going to employ the cash secured put option strategy with the mindset that the stock is going to continue to go up. Another strategy I would use if the stock shows clear signs is going to go up is what's known as a leaps option strategy. Because all signs point to the stock going up, then I'm going to go ahead and buy the dip with the leaps option strategy. With the leaps option strategy, you go ahead, you buy a call, the far out expiration date. Now, depending on how you want to use this leaps option strategy, that's going to tell you what date you want to use. Now, typically, a leaps option goes out for 1 year and beyond. However, once again, it depends on what strategy you want to use the leaps for. That's going to determine your strike date. So, just to summarize, when you see videos on YouTube or anywhere else that says buy the dip, they don't actually mean to buy the stock when it's going down. It's just something that's said to encourage people to pick up stocks at better prices. Now, the perfect way to buy the dip is when you see the stock shows clear signs that it's going back up. When the stock shows clear signs that it's going back up, there's a couple of strategies that can be used. With my personal portfolio, I would start using a cash secured put, or I'm going to DCA into the stock. Once again, that's dollar cost averaging. And my best and most important strategy in my option portfolio I'll be using is going to be the leaps option strategy. Now, if you guys found any value in this video, go ahead, like the video, subscribe to the channel. More importantly, if you guys have any questions about any strategy I went through in this video, or when's the best time to buy the dip, let me know in the comments below. Now, lastly, go ahead and share this video with someone you think can benefit from its content. Let's help as many as we can. And until the next video, do not buy the dip. Just kidding. Keep pushing your investments.